Let's take a look at Chapter 2. Chapter 2 is two big topics, the qualified business income, which we'll call QBI, and then a little bit about pass-through entities. Now, the QBI is for pass-through entities, but we have to know what a pass-through entity is, obviously, if we're going to understand QBI a little bit better. So just want you to be aware of that. And the way they do these in these chapters is they give us what they call the big picture, and every chapter does these, and they're really good. They just give us an example of a tax situation, and they ask us some questions, and then as they go through the chapter and the material, we'll come back and revisit these and answer the questions. So in this one, we have Amy. She's going to start two businesses when she graduates from college. One of them will be to use social media to promote her skills and experience as a volleyball player to basically coach younger players. So she wants to generate income from advertising on social media sites. And then she also wants to be artistic and use her artistic and marketing talents to find work using several web platforms like Upwork and Freelancer. And if you don't know what those are, they are websites where you can find somebody to do various jobs for you as an independent contractor. So you could contract with somebody to do a marketing campaign for you or use their skills for some particular thing that you need done, and then you pay them and you move on, and they're just an independent contractor, not a full-time employee. So Amy doesn't know how to set up her business. Should she form a corporation or a limited liability company, or maybe even just as a sole proprietor? And so the answer is it depends, right? There's never really one solid answer when it comes to these kinds of things. The answer is it depends. And she's curious whether for tax or legal purposes she has one business or two. So that's part of it too. Should she have one business to do the social media stuff? Should she have in the volleyball stuff? Should she have another business to do the freelancing that she plans to do? So she's trying to figure that out. And so after reading the chapter, we're going to help Amy out with her questions. And just as if we were a tax practitioner working at an accounting firm or attorney's office or something like that, and so somebody came to us with this question, we'd be able to obviously give them the right guidance that they need. So just some reminders about the business forms, and I'm assuming by now you've seen most of these. So everybody should be aware of these. Sole proprietorships, one person owns the business. A partnership is two or more. Trusts and estates, we'll get into that later on in the chapter. That deals with estate planning, what to do after death, how to leave money aside for your heirs, and so on. Then we have S corporations, it's called subchapter S, and that's just a chapter of the IRS code. Then regular corporations are called C corps and LLCs, limited liability companies. So we'll get into what each one is in just a little bit more detail here. And as I mentioned, sole proprietorships. Now the key for our class is they're not a separate taxable entity. They're what we mention as pass-through, meaning your business's income passes through to the owner's personal return. So if you have a sole proprietorship, on your tax return, you file a Schedule C. It's basically an income statement for your business. And your net income or your net loss from your business flows through to your personal 1040, and that's where you pay your tax. So coming back to the big picture, obviously for Amy, the easiest thing to fill out is a sole proprietorship. There's absolutely zero legal documentation needed. I don't need to go to a law firm and draw up any kind of legal papers for me. All I really need to do is separate my business income from my personal income. And to do that, it's pretty easy. Go to a bank, get a separate bank account for my business, and then also use a specific credit card for my business. It can be a credit card you already have, but the goal would be to only use that card for business expenses. And that makes it really easy. If you just pay everything with a credit card on the business side, that statement you get every month is basically your expenses for the month, right? So it's super easy to do that. So number one, just get a bank account and use a credit card exclusively for your business. Very simple. Now with a partnership, again, very easy to form. You should have some kind of articles of partnership. You can definitely go through a law firm or something like that to do that. probably also download something on the internet, tweak it to what you want you and your partner to agree on. Each of you sign it and go from there. Again, you want separate bank account, you want separate credit card to track everything. Again, it's a pass-through, just like the sole proprietor is, and you file a Form 1065. So instead of a Schedule C for a sole proprietorship, you file a 1065 for a partnership. Okay. And then you have to also keep in mind, it's possible that some items on a partnership return apply only to one of the partners and not each partner equally if it was two people, for example. So it's a little bit trickier to do. It's not that bad, but it gives you examples of things that might belong specifically to a single partner, and that would be dividends, long-term gains, charitable contributions, and investment expenses. And the reason for that is, remember, this is still a pass-through, so the owner is going to receive their share and pay tax based on their personal return of things like dividends, long-term gains, get the contributions, and so on. Well, every partner is going to have a different tax situation, be in a different tax bracket. Their filing status of married and all that will be different. So you have to separately identify those items because they pertain to each partner's particular tax situation. So each partner gets a K1. And that's what helps them then get the information from the partnership that they then need to transfer to their personal 1040. Okay, then S corporations. I worked for an S corp. It's a corporation, but it's closely held. So it's a separate entity. It only pays special kinds of taxes. So most of it is a pass-through. So they file a Form 1120S, and the S just means for a subchapter S corporation. It's very similar to partnership taxation. You have to separately identify certain items and so on. But the S Corp kind of gives you some of the benefits of the corporate form, which we'll talk about in just a little bit. But it's still kind of like a partnership. So it's kind of a hybrid between partnership and a full corporation. So the C Corp is kind of what we know as most corporations as. Any stock that we could buy off of a market is a C Corp. C Corps don't have to be publicly owned. They can be privately held. And a lot of the information when we cover C Corps in this class, a lot of them will be really C Corps that are closely held, maybe just a few owners. And that's okay. But so they don't have to be publicly owned. It's just that publicly owned companies are C Corps. The issue with C Corps, good and bad. The bad is that they are double taxed. They're a separate taxable entity. So C Corps themselves pay tax. They file a Form 1120. The federal tax rate on corporations is a flat tax of 21%. That's the federal amount, is 21%. Keep in mind that the vast majority of states have some kind of a state income tax for corporations, from small percentages to large percentages depending on what the state is. The state of South Dakota does not have that. So if you're a corporation doing business in South Dakota, you just pay your federal tax, and that's where that ends. Remember that corporations are taxable. They also quite often pay dividends to their shareholders. The shareholders receive those dividends and also pay tax on those dividends. That's the double taxation, which is what they're talking about right here. Okay. From your individual tax class, you know that the individual tax rates are between 0 and 37%. If you're a higher wealth individual, you'll pay at that upper 37% bracket. Dividends, though, are not taxed as high. It's either 0, 15, or 20. It's one of those three. It just depends on what your federal tax rate is. What's your bracket? If you're in the upper bracket, the most you'll pay is 20%. Most people, the vast majority of people, will be in that 15% range. Just a few people will be in the 0% range. And the same rates that apply to dividends, I want you to note, also apply to long-term capital gains. So because of that double tax, Congress has reduced the amount of tax you pay on a dividend. So imagine if you're a high wealth individual and you're in the 37% tax bracket, owning stocks and receiving dividends should look pretty good to you, right? That should be a pretty good income play because I only pay 20% tax on that. And the reason I only pay 20% tax is these earnings are already taxed at the corporate level. So the government's still getting theirs, but it could be a tax benefit. And most people, as individuals, if you look, kind of call the middle class, you're going to be in the low 20s as your tax bracket. So even 15% is still a tax break. Okay, so then of course corporations, when we talk about a C Corp, and we're talking about Amy here, if she should set up a C Corp, of course you have to talk about what the tax rates are, what kind of business income are we dealing with, will there be losses, employment taxes and state taxes. So all these things kind of factor into should we choose the C Corp, yes or no. And we talked about the corporate income tax rates. Most on the individual side, as you guys know, it's mostly between 10 to 37%. In many cases, taxes will be greater in the corporate form. Just kind of keep that in mind, okay? So the corporate form. And we'll talk about why that is. Non-tax considerations, I think everybody should be fairly aware that on the liability side, sole proprietors and partners have unlimited liability, right? So if they take out debts for their business through a bank and their business cannot afford to repay those debts, the bank could go after their personal assets. If they are sued by a customer or anybody in the pursuit of doing their business, if they don't have good insurance to cover whatever claims there are, their personal assets could be liable. And also keep in mind that sole proprietors and partners, it's harder for them to raise large amounts of capital. It's just harder to do. Corporations have a little bit easier way, and as do partnerships. Sole proprietors really just have to rely on their own funds or bank loans. The more partners there are, the more people there are that might have available funds, and corporations have a much easier time, because they can sell stock. And also transferability. Stock is easily sold, very easy. That's kind of one of the advantages of it also. When it comes to selling or buying into a partnership, partners must basically approve the transfer. And corporations exist indefinitely. They're a separate entity, separate from the lives of their owners, which is not the case for sole proprietors and partnerships. Corporations have a board of directors, which is good and bad. Like centralized management can be good. Partnership operations are basically just, each partner is doing their thing under the umbrella of the partnership agreement, but we don't have a centralized board that we have to run everything through. So a hybrid is an LLC, and I'm sure most of you have heard of the term LLC, limited liability company. They started in 1988 when the IRS ruled that these were kind of a legitimate type of a thing. However, the tax code doesn't really necessarily ever mention LLCs. States created them, and the IRS has kind of ruled, okay, we're okay with that. So the nice thing about them is they allow owners to avoid unlimited liability, and they're a pass-through. So allows qualifying business to be treated as a proprietorship or partnership for tax purposes, and that means you're not a separate taxable entity. So you kind of get the advantage of I'm a pass-through, and I also get the advantage of the owners are not facing unlimited liability if things go bad. And then you might see a problem or a question or two that deals with 1997 and the classification. It says sometimes difficult to determine if an entity is taxed as a corporation. If it has major corporation characteristics, it's taxed as a corporation. And basically, most entities have the following characteristics: a number of associates, and obviously to carry out a business to share in profits. And also continuity of life, centralized management, limited liability of owners, and free transferability of ownership interests. If it has those types of things, then the IRS will say, well, that's a corporation. That looks just like a corporation. Before or after 1996, it's a check the box. Basically, you can choose the tax status of an uncorporate entity without regard to corporate and non-corporate characteristics. So there's kind of that cutoff of 97, after or prior to 97. And so we have to kind of think that check the box is you make the election. You literally check a box on a form. Okay, if no election is made, multiple owner entities treated as partnerships, a single person entity to be treated as a sole proprietorship. Okay, so now the major part of the chapter from here is all the new stuff from the TCJA. So keep in mind, when this law was passed in December of 2017, it went into effect January 1 of 18. So all of 18 and now all of 19 will be subject to this. And the goal of the act was to reduce taxes across the board, not just for corporations, but for individuals. And so it's easy to reduce the rate on corporations because there was a federal tax rate on corporations that was scaled, just like it is for individuals. You know, corporations could pay anywhere from 0 up to 39%, depending on various factors. And now it's at 21% just flat for all corporate income. But a lot of businesses act, that are very profitable and are in the economy are not corporations. But the goal was to give those non-corporate businesses a tax break. And so Congress came up with the QBI, Qualified Business Income. It allows up to a 20% reduction on QBI of non-corporate taxpayers. So that's everything else, partnerships, S-corps, sole proprietorships, LLCs, and so on, all the pass-throughs. Okay, because remember, the owners are paying the tax, not the business itself. So the challenge was, how do we give a tax break to those businesses? Because we're giving one to corporations, we want to be equal with that and give one to all businesses the best that we can. Okay, now this is not permanent. This will expire in 25, so who knows what will happen then. I think that there's compromises with any laws passed, and one of those compromises was that this was not going to be permanent. Okay, so this chapter now will deal with QBI because it's going to be around for a few years at least, and who knows when that might become permanent, or maybe it'll go away. We don't really know. Okay. And so we want to appreciate the purpose of the deduction to reduce the tax on business income derived outside of the C Corp form. Okay, so that's really the purpose of the deduction. Non-C Corp businesses, how do we give them a tax break? So the general rule, and of course there's always exceptions, deduction from the QBI is 20% of qualified business income. So that word qualified means it has to fit the definition of what business income is, generated through sole proprietorship, partnership, S-corp. In general, it's the lesser of 20% of the QBI or 20% of the modified taxable income. So QBI is a deduction from your AGI. So remember, from individual tax, what AGI is, that's your adjusted gross income. Okay, the last deduction that you take before you determine what your taxable income is. So you have your AGI, you slice off your QBI deduction as an owner of that business, and then what's left over would be your taxable business income. And you apply your various tax rates on your individual return to get what your tax liability is. Okay, so 3 limitations. It's based on modified taxable income. We'll get to what that is. Another one applies to high income taxpayers, and the third applies to certain types of businesses. Okay, so kind of just keep in mind we've got the 3 limitations. The second and third limitations only apply when taxable income before QBI deduction exceeds certain amounts. So in 2019, and this goes up every year based on inflation, the 2019 amounts are $321,400 for married taxpayers filing a joint return, and then half of that, $167,000 for everybody else. Okay. So the second and third limitations apply to high-income taxpayers and certain types of services businesses. Okay. In all cases, the deduction in 199A, Section 199A is just the part of the tax code that has this information in it, may not exceed 20% of the taxpayer's modified taxable income. Modified taxable income is income before the deduction of QBI and reduced for any net capital gains. Okay, so net capital gains are excess of long-term capital gain over short-term losses, and then any qualified dividend income. Okay, so you can keep those in mind too. So what is QBI? That's the big question. Is basically ordinary income less ordinary deductions as a taxpayer earns from a qualified trade or business in the U.S. by the taxpayer. also includes distributive share of these amounts from each partnership or S-corp interest held by the taxpayer. Keep in mind that some people own multiple businesses, or they have shares of multiple businesses. A lot of entrepreneurial type people, that would be kind of what's going on with them. They might have ownership interest in various businesses. So again, it's basically the income of a business. Okay, so QBI is basically the income of a business. That's what qualified business income is. Okay, but however, it does not include certain things. So it's just your ordinary income. It does not include capital gains or losses, dividends received, or interest income, unless it's properly allocable. We'll get to that later. And certain other investment items. Nor does it include reasonable compensation paid to the taxpayer with respect to any qualified trade or business, or guaranteed payments made to a partner for services rendered. And we'll get into what those are later on. Okay, so for taxpayers who fall below critical taxable income thresholds established in 199A, the scope of a qualified trade or business is broad. In general, it includes any trade or business other than providing services as an employee. Taxable income thresholds are, and you can see we've already talked about what those are, the 321.4 and the 16700. As a result, the deduction is available to sole proprietors, independent contractors, non-corporate owners of S-corps, partnerships, and LLCs. Okay, so basically anything that's a pass-through. High-income taxpayers who are engaged in business involving the performance of certain services in specified fields are subject to certain restrictions, and we'll get to what those are in just a little bit. So if you have a multiple business, and there's more people than you might realize that have these, it must be determined separately for each qualified business. So there's several independent calculations that must be made, and the tax law, talks about that. The combined amount isn't compared to the overall modified taxable income. So you have to figure out what's the QBI for each specific business. That's a qualified trade or business that because some businesses don't qualify. We just haven't gotten to that yet. Okay. So remember that one limitation was based on a wage and capital investment limit. And the other limitation, those two limitations, first one's based on wages and capital investment. The second one is specified services. Okay, so businesses that do these things on this list here, doctors, dentists, lawyers, accountants, consultants, investment advisors, entertainers, and athletes, engineers, and basically have a limitation. Engineers and architects do not. Okay, why? I don't know. Why that is, I don't know. Just keep in mind that tax laws are political. They have to go through Congress. The House of Representatives initiates all tax laws before going to the Senate and then going to the President to be signed. And with any law, there are compromises. And sometimes it's just a matter of, do certain groups, lobbyists, are better than others? That might be the answer. So these taxable income thresholds determined with regard to QBI are, as we mentioned, those numbers. And then we also mentioned their index for inflation after that. Okay, so these limitations are fully phased in once taxable income exceeds these amounts. Okay, so 421.4 for married, and then half of that, 210,700 for all the others. Within the phase-in range, limitations are applied by comparing the amount of taxable income that exceeds the threshold to the appropriate phase-in range. So that phase-in range is 100,000 for married and 50,000 for everybody else. And then also, the limits to 20% QBI deduction is the greater of 50% of your W-2 wages, or 25% of your W-2 wages paid by the QTB plus 2.5% of their share of unadjusted qualifying property. Okay, and it's phased in, and we'll do some problems. It'll become more evident when we do some problems. So W-2 wages, amount of wages subject to income tax withholding, compensation paid into qualified retirement accounts, and certain other forms of deferred compensation. Qualified property includes depreciable tangible property, real or personal, that's used by the QTB during the year and whose depreciable period has not ended before the end of the taxable year. Okay, so phase in a W-2 wages capital investment limit. If the tax income before QBI deduction is less than the thresholds, the limit does not apply. If it's more than the thresholds, then W-2 wages and capital investment limits must be used. If taxable income before the QBI deduction is between the two amounts, between the W-2 wage capital investment portion of the QBI, then the general 20% QBI amount is used, but reduced as follows. Determine the difference between the general 20% QBI amount and the W-2 wages capital investment amount. So here's the formula to do that. And we'll do some homework problems together where I think that'll become more evident. So the phase-in of W-2 wages capital investment limits right here, determine the reduction ratio. So you can see right here, the reduction ratio is taxable income before the QBI minus the threshold, and we divide that by is the person married filing jointly or anybody else. So determine the reduction in W-2 wages and just kind of do the math here to figure out what that is. Okay, and again, we'll do a lot of homework problems that I think will help you kind of understand that better. So the specified services business limitation, for high-income taxpayers, we exclude specified service trades or businesses from the definition of a qualified trade or business. Okay, and that was the list we looked at: health, law, accounting, actuarial, performing arts, consulting, athletics, financial services, brokerage services, and so on. Any trade or business where the business's principal asset is the reputation of one or more of its employees or owners would also be in that. And architects and engineers are specifically excluded from this definition. So they made a point about that. The de minimis rule says that if a business which provides a small amount of services in a specified service activity are not considered as a specified service. So there's a test for that. If gross receipts are $25 million or less, it's a 10% test. If they're greater than $25 million, it's a 5%. If the specified service revenue becomes more than de minimis, the entire entity is tainted and now is subject to the limitations. Okay, so phase-in of specified services now. So the first formula was the phase-in of high wealth individuals. This is the phase-in of specified services. So it looks a lot the same, right? What's the percent? And you can see that we do a formula that looks a lot like the high wealth one. Okay, so taxpayers may aggregate businesses if the following requirements are met. So remember, it's not uncommon for one person to own several businesses or portions of several businesses. The same person or group of people either directly or indirectly owns 50% or more control. Control is met for the majority of the year. The same tax year is shared. You can have a different tax year, believe it or not. None of the businesses are specified services. That would be a key one. Business to be aggregated must satisfy any two of the following. So two of the three must be satisfied. Provide products or services that are the same or customer offer together. Share facilities or have some kind of a central business element. They're operated as in coordination with or reliance upon one or more of the businesses in the aggregated group. So there's some affiliation, some cooperation between the businesses. The aggregation can be done either by either an owner or a relevant pass-through entity. One owner may choose to aggregate that business with others, while a second owner may choose not to do so. Aggregation is optional and cannot be changed subsequently. In case of a change in facts and circumstances, a taxpayer must reapply. Aggregation is done before computing the QBI deduction. And then to include a business within the aggregated group, the activity must rise to the level of trade or business. If a taxpayer has QBI loss in 1 year, no QBI deduction is allowed. Okay, keep that in mind. And then to coordinate with others, the QBI deduction is allowed only for income tax. As a result, does not reduce the tax basis or self-employment taxes or the net investment income tax. Okay, we haven't really gotten into what those are yet. Also, in computing an individual's alternative minimum taxable income, QBI is not a part of that. Okay, so let's go back to the big picture in Amy. Obviously, it'd be easiest for Amy to have a sole proprietorship. If she generates losses, they can be used to offset other income that she might have, because remember, she has 2 businesses. And maybe she takes on a part-time job until her other businesses are big enough that they can provide enough income for her to support herself. If the risks for her business, such as injury to customers, are minimal, she'll likely find that forming an LLC or a corporation to reduce her personal risk is not warranted, right? So if she is doing coaching, possibly, but her coaching is, they really didn't talk much about coaching, but they did mention she's going to use her social media platforms as an influencer. If she's going to be coaching, though, there might be a risk of injury for somebody she's coaching. In addition to formation costs, continuing fees, and possible business taxes you might owe her state or residence can be avoided, and Amy can purchase insurance to reduce the cost of any personal risk, which is what she should do. If she's going to be coaching somebody, she should have some kind of insurance to cover anybody getting injured under her being coached. If she wants a more formal structure, legal structure to reduce her personal risk, an S Corp would do well, as it allows her income and losses to follow through to her individual return. As her income grows, she might consider converting to a C Corp due to the 21% maximum rate, although she has to consider double taxation if that happens. So if she takes a dividend out, that get taxed. And of course, the QBI deduction is important. Obviously, if she's a C Corp, there is no QBI. Until her income reaches the thresholds of the specified service, trade, or business, she should obtain a deduction even though both her pursuits might be specified services. Consulting or where principal business asset is Amy's reputation or skill. So it's possible, we don't know for sure. Finally, she should consider state and local income taxes. And of course, this would just depend on what state she is in. If she's in a high tax state or not, that would, so I guess the whole point of some of these is just to ask a bunch of questions, right? So we didn't necessarily really answer what she should do. The answer is it depends, right? It depends. And she has a variety of choices. And we present her what her choices are and help her, guide her to make the best decision. And so we're giving her options, but it's up to her ultimately to choose the options. And it's going to be based on her vision of the company also, which we really don't know. But also keep in mind that her plans may change. Maybe the business gets bigger faster than she anticipated, or maybe it just doesn't pan out and she decides to take on a full-time job, and so that would change things also. So whatever we do is not necessarily locked in stone forever. We can change based on the business changing. Okay, hope that helps. We'll also do some problems together, which will provide some more clarity.